conscious I'm the only person keeping you from the drinks and the canapes, so I will hopefully give you an insight into the area of non-standard finance. So I'm continuing the theme of a bit of variety in terms of your subject matter. So maybe a bit about non-standard finance and what are we talking about here? So this is just to give you a bit of an overview that non-standard finance or subprime lending is not a niche part of the market. It's very large. It's estimated there are around 10 million people in the UK who can't borrow from the bank where they use their checking account. It's a pretty staggering statistic. So that's around a third of the working population are unable to borrow from their bank. And why can't they borrow? Well, either they tend to be lowly paid, or maybe they've got variable income, they have a low credit status, or they're credit impaired in some way. So if we break that down a bit more, obviously there's a small proportion of the population who are on very, very low income, so at the minimum, at or below the minimum wage. You've got 15% of the workforce are now self-employed. So this creates a real problem for banks because they see £1,000 coming into their bank account one month, 2,000 the next month, £500 the next month, and it makes it very difficult for them to ascertain, well, what are they lending against? So many banks just won't lend to self-employed people. County court judgments. So this is something which features on your credit record if you're ever taken to court because you miss a credit card bill, or you haven't paid your council tax, or you miss a mobile phone bill. That will stay on your credit record for 6 years. Now, last year in 2016, 912,000 county court judgments were issued. That was up 25% on the prior year. So this is a large population. If you think that 912,000 people are effectively scored out from the mainstream lenders for 6 years, if we look forward to the second quarter of this year, the figure was up 41%. So a lot of particularly councils and utility companies are getting very aggressive in enforcing people who don't pay bills. And of course, that means that those people are then scored out and can't borrow from the mainstream lenders. We've also got quite a lot of people who've migrated here, been here for less than 3 years. And again, most lenders won't look to provide credit to people who've only been here for a relatively short time. So we've got a big pool of demand coming from all these for all these people. Now, so what about on the supply side? So if we go back to pre-Lehman, pre the global financial crisis, there was a large pool of subprime lenders in the UK. Some of you may remember the likes of Welcome, Beneficial, Household, HFC, Black Horse, part of Lloyds Bank. You had City Financial, part of Citigroup. Post-Lehman, they all got out. They all exited. They were the near-prime parent companies said, we want out of subprime lending. And so they effectively just said they stopped all their lending and just ran off their book and collected out the loan book that they'd lent. So how did that feature on the street or for customers? There were probably over 400 branches of particularly firms like City Financial and so on. All of those closed, and we estimate that there was a loan book pre-2008 of around about 5.3 billion, and now that's been closed to around 300 million. So there's been a massive amount of credit taken out that's no longer there. Now, I don't think anyone would disagree that in the meantime, the demand for credit has not dropped. So there's been a big imbalance. So this community has been underserved significantly since the financial crisis. So that's the sort of investment case. That's sort of the why. So what are we doing, and how do we fit into this? So non-standard finance was started by my boss, is a chap called John Van Cuffler, and he is a City veteran. His sort of big claim to fame, I guess, was that he in 1991 he became chief executive of a business called Provident Financial, which has been in the news of late for all the wrong reasons. I'm glad to say that John left in 2013, but when he came and became chief executive of that business, it was around a £300 million business. He took it into the FTSE 100, and over the 23 years that he was chief executive and then chairman, he delivered a 68-fold return for his investors. So as I said, in 2013, at the end of 2013, he retired from Provident, but wasn't ready to give up working, and felt that, given the market opportunity in non-standard that I've talked about, he felt that he wanted to try and do the same thing again. So with his credentials, of course, he went to the investors of Provident Financial that had enjoyed a 68-fold return and raised 100 million in a cash shell from Woodford, Invesco, Marathon, Standard Life, Legal & General, others. And the whole idea was to try and serve this 10 million people that are underserved currently. So we're listed on the main market. Market cap's a bit higher now, around 250 million. Got around 600 staff. Our loan book is around 200 million. We've got 144,000 customers. And as you can see, we're all over the UK. And I'll go and we're in 3 different businesses, and I'll talk about that in a minute. We've got around 1,000 self-employed agents, because one of our businesses is doorstep lending. And we've got a balance sheet with 165 million of debt. So we're a cash shell, and we then we bought 3 businesses in branch-based lending, home collected credit or doorstep lending, and guaranteed loans. So I'll just talk a bit about each of those. So market position is very important. Our biggest business is Everyday Loans. This is a branch-based lending business. It's the largest in the UK. We've currently, as of today, we've got 52 branches open, and the next one is going to open in next month in Wales. We're also in the guaranteed loans business. We've got 2 brands, George Banco and Trust2. We're the second largest in the UK, and the third business is our home collected credit business, Loans at Home, and we're the third largest in the UK. Provident, despite all its problems recently, is still the largest, but we're the third largest, and we've got knocking on for now close to 100,000 customers. So talking a bit about each of these segments, because they are very different in terms of the customers we're trying to serve. So firstly, Everyday Loans. Again, this is all unsecured loans, so cash loans. And Everyday Loans, we're serving people who are on average income. So they're earning £30,000. They're probably a homeowner, but not necessarily a homeowner. But something has gone wrong in their past, which means that they can't borrow from their bank. So we're prepared to lend to them. And the great differentiator for us, when you're dealing with somebody in the subprime space, is you have to meet the customer. It's not sexy, it's not fintech, it's old school. But in our view, when you're dealing with someone in the subprime space, you need to meet them. Because any scorecard that any lender will tell you, oh, we've got the best scorecard, when you're dealing with someone in this space, you have to look them in the eye, you have to really understand, why are you in this situation? Why are you a subprime candidate? And we do that by meeting the customer face to face. So our branch-based business, we source leads through the internet, through financial brokers, and then if they pass through our initial screening, we invite them in for an interview, which takes maybe 45 minutes. And that's why we have branches all over the UK, because we need to be close to the customers. So as I say, average income customer, we're lending between £1,000 and £15,000 for a term of between 1 and 5 years. And the APR range at the near prime level is probably close to what most credit cards are, say around 24%. But we're prepared to look at people who are deeply subprime, and we lend up to an APR of around 2.99%. The second area, our second largest business or business area is guaranteed loans. So a guaranteed loan is where typically a younger person doesn't have any credit history at all. Maybe they've been at university, blown themselves up on their credit card, and they've got their first job, great salary, maybe £24,000, £25,000 salary, and they need a car to get to work. but they've got no credit history, so the mainstream lender isn't going to lend to them. So they maybe could go and borrow on their own, but because they've got no credit history, they'll be deeply subprime in credit terms, and maybe they won't be able to afford the loan that they need. If, however, they find a guarantor, which is usually a relative, father, mother, uncle, aunt, sister, brother, who will act as a guarantor, then we as the lender are prepared to reduce the interest rate substantially so that they can borrow the money. And basically it's a three-way loan. You've got the lender, you've got the borrower, but you've also got the guarantor who is legally obliged to step in if the borrower falls short. Again, loan size very similar, £1,000 to £15,000, 1 to 5 years, and the APR is there between 39% and 50%. And thirdly, we've got the home credit business, and again, very, very different customers here. So, average income, 14,500, so almost half that of the customers typically in the everyday loans. So these people are earning, £300 a week. A lot of them are on benefits, or they're in part-time work. And so this is the old traditional Provident Financial type business, which Provident started doorstep lending in 1880. And it's a business which is incredibly steady and is really almost immune to macroeconomic shocks. And the reason for that is because the customers, if they lose their job or if they have an income shock of any sort, benefits will step in and almost entirely, maybe not quite entirely, but will almost match their level of income. Clearly, if somebody here loses their job, then the benefits are not going to get anywhere close to matching their previous level of income. But in doorstep lending, it's incredibly good through the cycle. And actually, with Provident's problems of late, this year will be the first time that business has ever made a loss since 1880. And that really, I'm sure there may be some questions on it, but that was really all to do with their changing the way that they deliver the model. So those are the three business divisions. Again, just in terms of the makeup of our business, the green is everyday loans, the light blue is our home credit business, loans at home, and the dark blue is our guaranteed loans business. So in terms of the loan book, revenue and operating profit, you can see that everyday loans is the real engine. So a bit more about everyday loans. So you can see the map here just shows you everywhere where we have a branch today. Well, not quite today because there's one opening out in Newport next month. The orange ones, the ones we've opened this year. So we'll have opened 12 new branches this year. And the reason why that's important is so that we can be close to the customer. Loan book growth, been incredibly good. And the reason why it's been incredibly good, as I mentioned earlier, is that back in post-Lehman, most of the competitors exited the market. So everyday loans is by far and away the largest. There is one small competitor, relatively small competitor called Oakham, which is really in around the southeast, which has, I think, around 25 branches. We have 53, and we're significantly larger. In terms of operational metrics, and it's a bit small, so I'm sorry, I could have made this larger for you. But this is basically what this is showing. The bars are the value of net loans issued in each month going forward. You've got the green bar is 2015, the dark blue bar is 2016, and the light blue bar is what we've achieved so far in 2017. So this is loan volume. And then you've got the average yield of those loans that we're issuing. So the yellow line shows you the average yield each month of those loans issued in 2015. The red line is 2016, and the purple line is in 2017. So this is a business which is able to grow volumes and increase price. I'll say that again. So this is a business which can grow volumes and increase price. This just shows you the pricing power that we have as a business because of very, very few competitors. Loans at home. So this is our home collected credit business. Again, we have lots of branches up and down the UK. This is not customer-facing locations. This is where our agents, our self-employed agents, come in once a week. They sit down with their manager. They review their customers. Typically, an agent will have anywhere from 100 to 300 customers. And they're out lending and they're collecting day in, day out. Here you can see the loan book is the loan book growth is quite seasonal. The reason it's seasonal is because a lot of our customers take out loans at Christmas to fund the turkey and the presents, but they also borrow through other times of the year as well. So kids going back to school need winter coats, need a pair of shoes. They want to pay for a summer holiday, going to the caravan park by the sea. And so home credit customers tend to take out loans for a very specific purpose. And the reason they like home credit is because it's a fixed amount per week. And even if they miss a payment one week, they miss 2 or 3 payments because the market stall was closed because of bad weather, they know they never pay more than the total cost of credit right from the outset. And this is why it's popular, and this is why it's been popular since the 1800s. The growth in the business here is really driven by the agents, because customers are not loyal to a company that's providing this service, they're loyal to their agent. And these agents, most of our agents are, unlike the caricatures that you often see in the newspapers of, a shady-looking gentleman with tattoos and an Alsatian. In fact, they're typically middle-aged housewives who've lived on the council estate. They've probably been a customer of ours before. And it's this relationship, again, face-to-face lending is what we do. And it's this relationship between the agent and the customer, which means that we have a very profitable business. So lastly, George Banco, and I'm sorry, there's a lot on this slide. But George Banco and Trust 2, so we recently acquired George Banco. So George Banco is the second largest guaranteed loans business in the UK. On the top right there, it gives you some data on the size of the guaranteed loans market in the UK, which is dominated by a company called Amigo. You may have heard their adverts on the radio. And again, this is a product which has really captured the public's imagination because, of course, it means they can get access to credit, but at a much lower rate of interest than they would otherwise be able to do. When I bought my first flat, my father acted as guarantor. It was an informal arrangement, but the building society wasn't prepared to lend me any money without my father stepping in and saying, I'll stand in as a guarantor. So as a result of that acquisition, you can see this was where we were before we bought George Banco in terms of loan book, revenue and EBIT. And you can see that what we've now got is a really well-balanced business with branch-based lending, still everyday loans dominant in terms of loan book, 50% of total revenue, and at the moment is still dominating profitability. But as you can see, we're expecting our guaranteed loans business to grow fast. So where do we fit into the marketplace? Because there are lots of providers out there. I'm sure you see them on the television, on the adverts and so on. So what I wanted to do was just try and position it for you, so to give you some overview on the marketplace. So on the far right-hand side, and I've used the axis on the bottom is the APR that's charged, which is sometimes for very, very short-term loans. Of course, an annual rate of interest doesn't really mean anything, because if you're borrowing over 15 or 20 weeks, obviously the APR is going to seem absolutely huge. But that's just to give you a flavour. And then here you've got the typical loan size. So small loans, very large loans. So if we look at the far right-hand side, you've got all of the payday or the former payday lending companies, which are now moving to instalment loans. So back in 2015, the government demanded that all the payday loan companies had a payday cap of 0.8% per day, which is effectively an APR of around 1,200%. I know that sounds very high, but that's because they were issuing very short-term loans. So as you can see, all the former payday companies have sort of settled at or around the payday cap. Then you've got the home collected credit community, which is you've got Provident, you've got Morses Club, which is another listed company, and you've got Loans at Home, which is our business. Then I come over here, you've got the rent-to-own sector, so companies like Bright House, Perfect Home, Buy As You View. The FCA has had a really long, hard look at this, and there have been some things which they don't really like that's been going on there, so that business is that market's under some stress at the moment. You've then got the subprime credit cards, so Vanquis, which is part of Provident, Capital One and New Day. You've got some, in the middle of the market here, you've got some pure online lenders, so 118 Money, Likely Loans, which is owned by Oakbrook, and Avant, which has recently been bought, and actually they're no longer making any loans because they were losing so much money. And these are remote only, competing pretty closely with everyday loans. The great difference is we have branches, we meet the customer face to face. These are all remote only models, which sounds great because your costs are low, but their impairment is so high, they're losing money. And then lastly, you've got the guaranteed loans community up here. So there's Amigo, you've got George Banco and Trust2, which we own. Glow was a guaranteed loans business started by Provident, which they've actually decided to close. So that's just, it gives you a bit of positioning, but you can see here, there's just, when we come out to the above 100% APR, there's just no competition for everyday loans. Again, just emphasized by that pricing power I talked about earlier. This just shows you how we're funded. We recently refinanced all our bank debt. We've now went to the institutional credit funds. We've got total funding of 260 million, which will see us well through probably to the end of 2019. So we've got plenty of funding to deliver our underlying loan book target for all of our businesses, which is at 20%. We pay dividends. We have, it was interesting hearing the target set by one of the other speakers, about a 50% payout. That is what our objective is to do that. Will we do that this year? We'll wait and see. We paid a half-p interim dividend, and we'll see how this year goes. But I'm conscious of time, so I want to give you some time for questions. So that was a rattle through on non-standard finance.
Thank you very much. Any questions, anybody? Gentleman here.
I'm quite concerned about the most vulnerable people in society.
Yeah.
They can be charged about 700%
Yeah.
interest.
Yeah.
Yeah. What service are you all giving to them?
So the reason why our interest rates are high is because we have a very expensive product to deliver. So, and our most expensive in APR terms is home collected credit. So let me explain. So I'll give you a worked example. So one of our most popular products is a 33-week loan. So if you borrow £100 for 33 weeks, you will pay back £165 in total. So, but that £65 that we make, that's our revenue. So where does that go? What are our costs? So we'll pay the agent at least, well, probably £16.50, so 10% of the total amount they collect. So £16.50 goes to the agent. We will probably have to write off around 20, because whilst we're lending to 100,000 customers, what I do know is probably 20 to 30,000 of those are not going to pay. But I don't know which ones. So unfortunately, the reason why it's, one of the biggest reasons for our costs are so high is because we have high loss rates. So one thing that's often said to me and to us is, well, what about credit unions? Why don't credit unions work? Because they're great, because interest rates are really low. Why don't, surely credit unions are the answer. The trouble is that credit unions could never take the losses that we take, because they have a cap on the amount of interest they can charge. So around 42.6% APR, they're just capped by the rules on credit unions. But if you're going to lose 20% of what you lend, they couldn't take that. They'd all go bust. And indeed, many credit unions do go bust. So in answer to your question, we have an expensive model. We're a public company. We've raised capital to come and do this. Our investors have said, well, we need you to deliver a 20% return on asset. Otherwise, we'll go and invest in BP or Vodafone. So that's a backstop for us. But the service we're providing is we're making the credit available. And everybody needs credit. You have to understand, so our home credit customers, they're not feckless. In fact, they're incredibly good at budgeting. But what they like about the product is this gives them some flexibility to draw down on credit when they need it. And they also know that it's going to be a fixed amount per week. So in the example I gave, So in that case, the customer knows it's £5 a week for 33 weeks. But if they miss 1, 2, 3, 4 or more payments, they'll never pay more than 165. And that flexibility for someone on very low incomes, but the certainty that they're not going to get out of control, most of our is really important. Most of our home credit customers, they don't like credit cards. They don't want credit cards. They don't want an overdraft because they can't keep tabs on where they are. So in answer to your question, I would say we're providing a really valuable service, and we have some of the highest satisfaction rates in financial services of well over 90%. I think our closest would be First Direct in terms of getting anywhere close. We have very low complaints at the Financial Ombudsman Service. You don't hear lots about home credit customers, complaining about the service they're getting. They're getting a great service.
I work in the East End of London, and I find you all don't do capacity assessments on people.
Well, I can assure you we do.
No.
We're fully regulated by the FCA. Yeah. We're fully licensed. No. Fully licensed.
Because I challenged one of them, and they said if a person can bring all the right documents, the person has got capacity. Who in their right mind will get into a transaction where they might have to pay 5-6 times the amount of the loan?
Well, no, but we will never charge that much. You will never pay more than the cost of the loan, ever. None of our products are like that.